All right. Our next guest says the rally is back on and Santa Claus is coming to Wall Street. Let's bring in John Stoltzfus, the Chief Investment Officer over at Oppenheimer. John, great to see you in person.
Great to see you as well.
So how strong is this Santa Claus rally going to be, you think?
Well, I think we could probably get 7% out of it.
7% from here.
Where we are right now, yeah.
You mean in the next month?
It's a big bag of goodies.
From here to the end of the year, yeah, I think we could. And it doesn't mean it's not a straight up motion, but do you remember October 2014? There was some kind of a dip that occurred. Everybody thought everything was lost. By the end of October 2014, the market had made up where it had been. It was up around 7%, and to the end of the year, it had a nice run. I think we could get it. The reason why is the fundamentals are still good. People are plenty worried. That's a good sign. And there's a real hot fire under the chairs of both President Trump and President Xi, because they both recognize the fact that for Xi, it's 2025. He can't really risk hurting that image of made in China in 2025. And for President Trump, he's got a 2020 goal with the election coming up. And I think he wants to move on to other agenda points like infrastructure and health care. So I think we've got a good chance.
So help me think about the 7% rally that's going to happen in the next 3 weeks or so.
Yep.
And you said it's not going to happen in a straight line up, but it's really got to happen in a straight line up in order for you to get 7% by the end of the year.
The thing about it is, you know, the way this market is, it can be very volatile on a day-to-day basis, but it can be very quick to recuperate. And so I think we've got a real shot at that. I don't think my 3,000 target stands anymore.
What does that rally look like in terms of the sectors that get us up there?
I think we got an idea today. What were the best performers? I don't agree with energy, but I certainly like technology. And I like consumer discretionary. Consumer discretionary is benefiting from higher wages. People feel more confident that they're going to keep their jobs when they have jobs. And technology has just been abused ridiculously since October. If you consider that technology is probably at the point where the automobile was in the early 20th century when the car began replacing the horse. The changes are so dramatic in the way companies deal with other companies, the way they deal with their customers, the way customers deal with companies, and now medicine is around the corner to be distributed, you know, by smartphones, things like that. There's a lot of stuff happening, and the market's not recognizing it. And
so John, though, but when you talk about higher highs, you have divided government, so you don't get the pro-growth, you don't get regulatory relief, you have higher rates no matter how you slice it, even if you think he's moving slower. I don't think he's moving slower, and you have slower growth. So how do you get higher than what we've seen when the picture has changed dramatically?
Well, I think you're projecting overly dramatically. I don't think.
I didn't say 7% before the end of the year.
Okay. I do have to say this is I don't think what we have is a situation where the fundamentals have changed dramatically. What has changed are people's projections of what's going to happen and how long things are going to stay uncertain. And also a projection that things will remain as uncertain, at least as uncertain as they are, because the politicians won't get off a dime. But I think they are going to get off a dime because China is not doing well. It's slowing. It's got a lot of challenges. And in the U.S., we've seen some slowing come in, but it's not dramatic.
So what happens after the 7% is reached by the end of the year?
Oh.
Is that your opportunity to sell, or does the market keep going higher?
I think for traders, it might be a time to take profits if we get that. Looking into the first quarter, just because that would be a fairly fast run-up. But if you look at that situation, for investors, it'd probably be a good time to get in now, ride it, and go into next year with an opportunity to see this market continue to. This is a market that has risen for the last nine and a half, almost 10 years. It has climbed a wall of worry. It has also, though, it has paused at various times. We've seen the economy slow, and people right away start projecting recessions and a dramatic reduction of earnings, not related to tax reform, but just on a fundamental basis. And it doesn't happen. And I think what it is, from a fundamental perspective, technology and what the Fed has done have skewed the cycle, so we're in a very wide mid-cycle, maybe towards the end of that mid-cycle, but that's good for the market.
Okay. John, thanks. John Stoltzfus predicting that Santa Claus is in fact coming to town with a big giant bag, a 7%.
One of my favorite Rankin Bass of all the Rankin Bass.
Which
Christmas
one?
Shows,
Santa Claus
by the way.
coming to town?
Yeah, absolutely.
What's Rankin
Young
Bass?
Chris Frank. It's only for the deep cultured folks out there. Anyway,
In terms of the sectors that you ride to the end of the year, do you agree with John?
I tell you what, I think 7% is after the 7% we've already had looks very ambitious. I don't want to push back on John's fundamental thesis.
But you are.
But I would just say the places that benefit most from uncertainty for the next 4 months are the places that were most destroyed by the prospect of trade. So let's go to emerging markets, which today challenged the 100-day for the first time in almost 7.5 months. They're through the 50-day. A lot of technicals, and it's not usually what I would choose to talk about, but have been weighting down some of these other parts of the world. And you really were seeing a breakout. Even before this trade news came out over the weekend, you were seeing that breakout. So I would stay in those trades. Brazil continues to outperform, and I like the big mega cap China names.
Yeah, and Karen, in terms of retail, they sort of got to stay in terms of the additional tariffs that were going to come in.
Right.
Does the backdrop look much better right now?
It looks somewhat better. I mean, you talk a name like Coors, which was hit, Coors and Tapestry on tariffs, and the absence of tariffs is a good thing. Coors is trying to move their production out elsewhere and has been doing that for a while, but I agree with John, though, on the strength of the U.S. consumer. I think we'll have a good holiday.